Hey guys, Ralph here from the Endgame Investor, and today we're going to talk about the central bank, the issuer of the US dollar, losing a bunch of money, both in unrealized and realized losses. What that means, how to wrap it around your brain, what that means for other banks that hold the same assets that the central bank, the Federal Reserve, does, and why consumer prices will not stop rising by the time we have to encounter the next financial crisis, which will lead to the next round of printing, which will destroy the reserve currency of the world and bring the world back to gold and silver as direct media of exchange. Not that they are not media of exchange now, they are, but their value is only traded through inflated substitutes, which will die. And then the world will have to resort to the direct trading of these monetary media, gold and silver, because there will be no other choice. Once the pyramid collapses, you can't go to an extended layer of the pyramid and keep trading, because once the base falls, which is the US dollar, the rest of it falls as well, which includes everything on top of the US dollar, which includes equities and bonds and cryptocurrencies and derivatives and options of all kinds. And so first, let's check out the Federal Reserve's earnings statement. This is from Fred, our friend at the St. Louis Federal Reserve. This is a graph of earnings remittances due to the U.S. Treasury. The Fed has a deal with the Treasury that if it makes money, if it makes a profit on any of its assets, then those profits must go to the U.S. Treasury because the Fed is not allowed to retain a profit. Since December 2010, the Fed has had a nearly entirely consistent profit that it was what was remitted to the Treasury so they could spend it on more wars in Iraq and Afghanistan and Ukraine, or whatever they want to bomb. They can have fun doing it with as much as explosives as they want. And everyone's happy except the people that are being bombed, but that's a different issue. From 2010 until September 2022, which is like 2 months ago, Fed had a consistent profit and the Treasury was able to spend that about whatever it wanted, like, lollipops. Apple. But then the value of the assets on its balance sheet started to fall. And why is that? Because as you raise interest rates, that means that the value of the bonds on your balance sheet start to fall. The Fed cannot pay the Treasury. Well, does the Treasury owe the Fed? No, the Treasury doesn't really owe the Fed. So what does a loss mean? Well, that means that the assets on the balance sheet that are backing a dollar are now filled in with something called a deferred asset, which is something that doesn't exist. And so the backing for the dollar, which is represented by the assets on the Fed's balance sheet because the dollar is the liability, the backing of the dollar is now increasingly and increasingly backed by literally nothing. No assets, deferred assets, assets that do not exist.
It does not make sense. If Chewbacca lives on Endor, you must acquit.
The Keynesians that set up this entire central bank system will say that it doesn't matter, and central banks' earnings don't matter, and central banks' balance sheets don't matter. And my challenge to that is, well, if they don't matter, then just get rid of it. Get rid of the entire imaginary Federal Reserve balance sheet. Get rid of all of the assets on its balance sheet and just burn them with, like, a lighter. Like, take the mortgage-backed securities, print them out and then erase the digital copies, and you have a pile of paper, and just, like, take a lighter and use your thumb and, like, just set it on fire, and then there will be nothing left. And then the dollar should be fine because, a balance sheet doesn't matter. Well, the problem is it does matter because the central bank is just a centralized version of what a regular bank is. Now, imagine that you have a regular bank. How does it come into existence? It comes into existence because somebody has real money that they want to trade for things, that they can trade for things, but they don't want to store it themselves. So they say to a bank, they say to their friend, hey, can you store this money and give me a receipt for it? And whenever I give you this receipt, give me my money back and then I'll spend it. And then the bank says, well, you can just keep the money with us and spend the receipts. And then whoever has the receipts will honor his claim to the money in our vaults. And so the receipts trade at par with the money in the vaults until such time as somebody suspects that the vaults are empty because they spent the money on a new speculation called Flitcoin or Schmidtcoin or something, a new digital currency that will something, blah, blah, blah. And then everyone has a run on the bank and they return the receipts for whatever is in the basement. And then there's nothing left in the basement. And then the entire value of the receipt goes to nothing.
We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
This is a standard bank run. Now, what is a bank run on a central bank? A bank run on a central bank is, in other words, hyperinflation, which is coming because the central bank, is losing money. Now, it's not just losing, what was it, like 19 billion or something? Let's look at that chart again. $12.39 billion. That's not exactly what it's losing. It's losing much more than that. Let's go to the next tab.
I think I'll order a tab.
And the next tab is the Federal Reserve's latest earnings for Q3 2022. And you see here this number in parentheses 1,125,302 end parentheses. That means since these numbers are in millions, and you can see up here in that blue thing in millions parentheses, 1,125,302 million, which is 1.125 trillion. So the Fed is down $1.125 trillion on its portfolio of treasury securities and mortgage-backed securities, which should make you all warm and gooey inside about the status of the US dollar, the liability unit of this bank, which is deeply in the red. And now, as the Fed continues to raise interest rates, what happens is that demand for stuff starts to fall, which eventually hits consumer prices, but only last. The first thing that it hits is asset prices. And the title is Manufacturing Orders from China Down 40% in Unrelenting Demand Collapse. And here are two key quotes from this article. It seems to be a very bad time for the shipping industry. We have the combination of declining demand and overcapacity as new tonnage enters the market, it wrote. I don't know what it is. HLS analysts are predicting a further 2.5% decline in container volumes and nearly a 5 to 6% increase in capacity in 2023, which will continue to negatively impact freight rates in 2023. And so my question is very simple. If we're seeing a massive 40% collapse in demand for manufacturing in China, then why aren't consumer prices falling? Why are they still rising at like 8 or 9% or 10% or whatever the percent is? Does it really make a difference? It doesn't, because the CPI numbers are not some holy metric. They are a very rough estimation for how things are actually going. Why are consumer prices still rising while demand in the real economy in real time in the capital sector is falling off a cliff? That's because consumer prices are on a significant lag to what happens in the capital sector. The first prices that are affected by a shrinking money supply, which is what we're having now, those are the capital prices, meaning stocks, bonds, real estate, manufacturing, freight shipping, those kinds of things at the top of the structure of production. The last thing to get affected is consumer prices, and that is what causes stagflation as we see it, which is a contracting economy and rising consumer prices. It's because consumer prices are on a significant lag. When you think about it, the money printing that happened in 2020, the huge 40% rise or whatever it was in the money supply in a matter of months, that crazy inflation that has never been seen before in the history of the human race. The first thing that was affected by that was stock prices and bond prices and real estate prices, which all ended up in a crazy, insane bubble. Consumer prices were only affected by it about a year to 18 months later in 2021 and 2022, and we are now seeing the effects of that. So if the Fed continues on its current course to shrink the money supply and raise interest rates and simply continues doing that, then eventually, yes, consumer prices will fall, but it's going to take a lot of time. And what's going to happen before that is some bank somewhere in the structure of production is going to fail and cause a toppling domino effect, causing severe pain among the friends of the Federal Reserve and their commercial bank buddies. And this, the Federal Reserve cannot tolerate. So before we see any significant effect in consumer prices, we're going to see a huge hiccup, problem, oopsie in the banking sector somewhere. Now, I speculated it was Credit Suisse, but it could be anything. And whatever starts it is really an academic point. We know that it will happen, and I will bring you to another chart to show you why. This is the 10-year Treasury minus the 1-month Treasury. If the number is negative, that means that the yield on the 10-year Treasury is lower than the yield on the 1-month Treasury, which means that banks or creditors are willing to loan the U.S. government money at a lower rate for 10 years than they are for 1 month. And what is the only possible reason that 10-year money is cheaper than 1-month money? That is that lenders expect the Fed to buy the 10-year Treasury so that they can sell it to them at a profit, which means that the market is expecting another pivot. Now, if we look at this chart and inspect it, we see that this number, August 2019, when it hit a low of negative 0.63 percentage points or basis points, that was 1 month before the repocalypse of September 2019, when the repo market blew up and a whole bunch of printing had to be started. And this was before the world ended with the lockdowns. We saw the same thing happen in late 2006, early 2007, right before the 2008 financial crisis. And now we are seeing it again. Now, how long the yield curve between the 10-year and the 1 month, and it's the same between the 10 and the 2-year and the 30 and the 3-month, or whatever, permutation you want to make between the long-term bonds and the short-term bonds. They're all slightly different numbers, but they're all basically the same. How long is it going to remain negative this time? And I can guarantee you that it's not going to remain negative for very long. Here it was negative for maybe about a year. Here it was negative for maybe a few months. Here it just became negative in September. So we are on month 2 of the negativity in this yield curve spread. How long is it going to remain negative? Could be maybe a year, maybe less. It could change right now. It's impossible to know exactly, but the point is it cannot stay this way. And the way it goes back positive is that yields on long-term treasuries go way back down. And that can only happen if the Fed buys it all. And the only reason they would buy it all is because there's a financial crisis. And the other thing I will tell you for sure is that when the Fed buys its next round of paper, gold and silver are going to go up, and this time they are not going to go back down. Getting physical will be nearly impossible. In conclusion, my friends, the central banks are losing money. Their balance sheets are getting schmeiced, sliced, and diced, and they are bleeding. And this does matter, because if it didn't matter, then the central bankers would just say, oh, who cares about our balance sheets? Let's just forget it and stop accounting anything. And we'll just print money and hand it to the banks in exchange for absolutely nothing, because, whatever. That's the fiat system. That's not what they do. When they bring money into existence, they always purchase an asset in return, because the dollar has to be backed by something, whether it's gold or paper assets in treasuries or mortgage-backed securities. There has to be a backing to a dollar, because a dollar is a money substitute. Either it substitutes for gold or it substitutes for a lesser and lesser quality debt. And that debt, as long as it can be paid back, does have value, but eventually it can't. And when it can't, the debt defaults, and the only thing you're left with on the balance sheet is the gold that remains there. We are not in a magical fairyland monetary system. We are in a real monetary system that is backed by increasingly insolvent debt paper. The balance sheets of the central banks are showing it. They are becoming bankrupt. They are bleeding badly, and they do not have much time left. This is Rafi with the Endgame Investor. You can subscribe to my YouTube channel here by clicking the subscribe button, or you can become my patron on Patreon at the link in the description below, where you'll get a weekly video of biblical commentary on monetary and economic policy topics. Or, of course, you can subscribe to the Endgame Investor, where you will have front row tickets to the end of the monetary world as we know it, and we will all feel fine.
6 o'clock TVO.
It's gone. It's all gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.